Hello. In this presentation, I'm going to look at the role of financial management and, in particular, the central role played by financial management objectives. Specifically, this presentation will cover the role of financial management, financial objectives, financial decisions, financial constraints, and not-for-profit organisations. Let's look at each of these in turn. The role of financial management. If you are asked to define management or what managers do, you are likely to come up with terms such as control, decision-making, coordination, resource allocation, motivating employees, etc. Whilst these are all valid terms, what do they actually mean? In other words, what or how do we control? How do we know what decisions to make, etc.? Returning to the original question, therefore, all of the terms defined above combine to guide the organisation towards a predetermined outcome. In other words, an organisation cannot think about management until it has identified what it is that it is trying to achieve, i.e., what its objectives are. In the context of financial management, before we can consider the types of decisions that financial managers have to make, we must determine what our financial objectives are. Financial objectives. Firms will usually have a number of objectives, and these are often characterized as primary objectives, the reason for existing, and secondary objectives, the actions which promote the achievement of the primary objectives. For example, improving staff morale may be a secondary objective if it is believed to improve customer service and therefore the profitability of the organisation. Putting that to one side, the primary objective of a profit-making organisation is usually assumed to be the maximisation of shareholder wealth. Maximisation is not ideal in that it is very difficult, arguably impossible, to know when something is as good as it can possibly be. In practice, companies will aim to increase shareholder wealth by a level that is acceptable to them, and this aspect is considered in the cost of equity presentation. Notwithstanding this last point, the maximisation of shareholder wealth can be achieved either by increasing the company's share price or by paying out a dividend. The success or otherwise in achieving this objective can be measured in terms of total shareholder return, which is the dividend yield plus the capital growth, both expressed as a percentage. Dividend yield equals the dividend paid in the year divided by the share price at the start of the year. Capital growth equals the movement in share price during the year divided by the opening share price at the start of the year. Financial decisions. In an attempt to achieve the objectives, financial managers have to make a number of decisions. These can be categorized into three groups as follows. 1. Financing decisions as to how the company will raise the necessary finance. This is considered in the sources of finance presentation. 2. Investment decisions as to where the company will invest the finance raised. This decision can itself be split into three categories, namely working capital, investment appraisal, the improvement in the infrastructure of the existing business, and company acquisitions, the purchase of new businesses. 3. dividend decisions as to whether companies should reinvest profits earned, referred to as internal finance, or distribute them to shareholders as dividends. Whilst these decisions have been defined individually, it is important to remember that in practice they will impact on each other. For example, the cost of raising finance discussed in the weighted average cost of capital presentation will be a major consideration in determining the viability of an investment appraisal considered in the NPV presentations. Financial constraints. So far we have described how financial managers will make decisions that it is hoped will guide an organisation towards the achievement of its predetermined objectives. It is important to remember, however, that managers' ability to do so freely will often be constrained by other stakeholders who have their own objectives for the company. Examples may include governments may impose regulations around health and safety concerns, or refuse to allow acquisitions if they see them as reducing competition. Banks may impose restrictions, referred to as loan covenants, in an attempt to ensure that loans are repaid. For example, they may limit the size of dividends or restrict the amount of other borrowings. Managers themselves may have their own agenda in terms of their own pay and perks or popularity. This is referred to as the agency problem and may be overcome either by good corporate governance or by incentivizing them in a way that benefits shareholders, for example, share options. Not-for-profit organisations. So far, this presentation has assumed that all businesses are profit-making, or at least trying to be, and that they aim to maximise shareholder wealth. Clearly, this is not the case. Many organisations are non-profit-making, and often these will not have shareholders. Examples will include central and local government, public sector organisations, for example schools, hospitals, etc., charities, and so on. This certainly does not mean that finance is unimportant. Indeed, arguably, finance becomes even more important simply because the amount of finance is limited. It may also be the case that there are limited opportunities to raise finance. For example, schools cannot issue share capital, etc. For this reason, it is essential that any money they do have is used well. This is often referred to as demonstrating value for money and is measured in terms of the 3 E's: economy, efficiency, and effectiveness. Economy refers to obtaining inputs of appropriate quality at the lowest price. Efficiency refers to maximizing the outputs from any given quantity of inputs, and effectiveness refers to the achievement of organizational objectives. As with the 3 decisions outlined above, financing, investment and dividends, again it is the interaction of the 3 E's that is important, and in particular achieving an appropriate balance between them. Thank you.